Welcome back from our last break. We have one more time slot today before the end of our event. We will be splitting the session between commercial activity tax with Mary, who just joined us, and then she will be turning it over to Derek to talk about some updates with our municipal net profits tax. So I will turn it over to Mary. Thank you.
Thank you, Teresa. First things first, I just wanted to say good morning and a thank you to everyone who decided to attend today to learn about the updates to commercial activity tax. As Teresa stated, my name is Mary Burkholder and I'm a tax examiner manager in the business tax division. Today, we are going to review some of the updates to the CAT. My hope is by the end of the presentation, you have a clear understanding of the CAT changes to help determine how they may or may not affect you. Before we begin, there are a few items I would like to review with you based on recent phone calls and correspondence that the department has received. Commercial activity taxpayers who anticipate to have less than $3 million in taxable gross receipts in 2024 should cancel their account effective 12/31/23. This can be done by calling the department directly, submitting a business account update form, using the CAT cancel transaction on the gateway, or by checking the cancellation box when you file your final 2023 annual return or the fourth quarter 23 return. We are also experiencing a lot of taxpayers calling stating that their CAT account was canceled in error. Therefore, please be careful when you read over the CAT cancellation checkbox before you mark that box and cancel with the return. Another common scenario we are receiving is taxpayers are not able to use the CAT cancel transaction on the gateway. If your CAT account has already been canceled by any of the previously mentioned options, you will not be able to use the CAT cancel transaction on the gateway. You can view if the CAT account was previously closed with the return by reviewing the return summary located in the History tab on the gateway. And then we want to provide this disclosure slide here just to inform everyone that today's session is going to include a high overview of general information, and any of the information should not be considered legal or tax advice. Any changes made by legislature may change the accuracy of this content. Also keep in mind that depending on your situation, any small difference can change the outcome and have a different impact on how the changes can impact you specifically if you are in a group, which we will go over that here in this presentation. As always, we have a fantastic group of examiners ready and willing to assist you during our business hours at the number you see here on the screen. The House Bill 33 was passed and included quite a few changes that affect the CAT. With that said, our taxpayer base for CAT will be decreasing quite significantly due to the new thresholds, which we will go over here in a bit. For today's topics, we will be going over what CAT is, how you know if you're subject to the tax, the filing requirements and in the future, and the frequently asked questions that the department has received so far regarding these changes. The first topic we will discuss today is what is the commercial activity tax? For a little background, historically, there was a corporate franchise tax that was phased out and replaced by the CAT, with CAT being enacted in 2005. This is general information, and we do have resources available at the end of the presentation if you would like to read more on the wonders of the tax. It is also important to consider common ownership with CAT, as it does require individuals with common ownership to file as one taxpayer. Here we're referring to a taxpayer, but this could be a group of entities that are commonly owned by individuals or businesses. So what is the commercial activity tax? CAT is defined by three main criteria. The first point is that CAT is an annual tax imposed on the privilege of doing business in Ohio, measured by the taxable gross receipts from most business activities. We do have information release 2005-17 located on our website at tax.ohio.gov that does clarify what constitutes a taxable gross receipt for commercial activity tax purposes. Next, the CAT applies to gross receipts that are sitused to or sourced to Ohio. You should only report receipts that are sitused or sourced to Ohio only on these CAT returns. And so a little help with the difference between gross receipts and taxable gross receipts. Gross receipts reflect the total amount realized without the deduction for cost of goods sold or other expenses that are incurred in a transaction or a transaction that contribute to the production of the gross income, including the fair market value of any property and any services received. Taxable gross receipts are the receipts that are sitused to or sourced to Ohio. And then finally, taxpayers with taxable gross receipts of more than $3 million in the 2024 calendar year are subject to the CAT. Please note that periods prior to 2024, taxpayers with taxable gross receipts of more than $150,000 in the calendar year were subject to the CAT. Beginning January 1st, 2025, taxpayers with taxable gross receipts of more than $6 million in the calendar year are subject to the CAT. So again, these are the three main criteria associated with the CAT tax: doing business in Ohio, what it applies to, and the taxable gross receipts. So now that we know what CAT is, let's take a few moments and talk about the filing requirement. And we will also go over the annual minimum tax and what has changed with that. So beginning in 2024, annual filing will no longer be available. All taxpayers that remain subject to the CAT will be required to file quarterly. The quarterly deadlines will remain the same: May 10th, August 10th, November 10th, and February 10th. Keep in mind that these dates can fluctuate depending if it falls on a weekend or a holiday, and the due date would then be the next business day. If you cancel your account now, you will still have a filing requirement for 2023. Something to keep in mind that tends to be misunderstood is that even if you did not have any taxable gross receipts for a particular period, it does not remove your filing requirement for CAT. This is why we are emphasizing that you should cancel your account if you become aware you will no longer be subject. And then this slide here is just to visualize some of the changes. On the left is how the annual minimum tax was previously structured. Taxpayers utilize their previous year's, calendar year's, taxable gross receipt to determine their current year's annual minimum tax. For receipts less than $1 million, the annual tax was $150. For $1 million to $2 million, the annual minimum tax was $800. $2 million to $4 million, $2,100. And then receipts that were greater than $4 million was $2,600. On the right-hand side, you can see that beginning January 1st, 2024, the annual minimum tax has been eliminated. The CAT tax rate of 0.26% will be charged as tax due on receipts exceeding the new 3 million threshold. Beginning January 1st, 2025, the rate will be charged on receipts exceeding the 6 million threshold. Please keep in mind that when returns are filed on the gateway will automatically apply the exclusion starting with the first quarter return as it does now. For annual filers, if you file your 2023 return with less than 150,000 in taxable gross receipts and qualify for a refund of the 2023 annual minimum tax, we will process the refund without a refund claim. You can still submit a refund request, but it is not required as we are going to be reviewing the accounts and issuing refunds for any annual minimum tax credit overpayments. Refunds are mailed to the last known address that the department has on file. So to be sure that the department has a valid mailing address, you can utilize the transaction CAT company information change, which is located on the gateway, to submit an updated mailing address. So what happens now? There are updates that have been made to our website at tax.ohio.gov, which we will also go over here in a minute. But as previously mentioned, you can cancel your CAT account by using the checkbox on the final return. If you cancel using the checkbox, you do not need to complete the CAT cancel transaction on the gateway since the account has already been canceled. So as you can see, as of January 1st, 2024, taxpayers with taxable gross receipts not exceeding the 3 million threshold will want to cancel their account effective 12/31/2023. The annual return was due May 10th, 2024, and the fourth quarter 23 return was due February 12th, 24. So for 2025, here are the requirements. Beginning January 1st, 2025, taxpayers with taxable gross receipts less than the 6 million threshold will need to cancel their account effective 12/31/2024. This can be done when filing the fourth quarter 24 return, submitting a business account update form, which is located on tax.ohio.gov, using the CAT cancel transaction on the gateway if you did not use the box on the return, or by simply calling the department. The fourth quarter 2024 return should be filed on or before February 10th, 2025.
All right, thank you, Mary. We are ready for our first poll question of this segment. It's a multiple choice, a little different than what we've seen so far today, and it's please select at least 2 of the following 5 options on how to effectively close your CAT account effective December 31st, 2023. So the first option, checkbox on my tax return with an end date of 12/31/2023. Next option is stop filing. After that, it's submit a paper business account update form, send a carrier pigeon, or complete the CAT cancel transaction via the gateway. So we will give everybody a couple more seconds to respond. Again, for those seeking continuing education credits, we do need you to interact with the poll. So please select an option there. It does not need to be correct. You just need to select an option. If you are having some connection issues, please send an email to ovta@tax.ohio.gov. Again, ovta@tax.ohio.gov. I sent a chat message to everybody. It should be available in the question pane with that email address. So we have the vast majority of people who have submitted the response. Mary, what are the options here that you would want to reiterate to everybody?
Yes, of course. So the correct answers were the first one, check the box on the tax return with an end date of 12/31/23. You can submit a paper business account update form, or the last option, complete the CAT cancel transaction via the Ohio Business Gateway.
Fantastic. Thank you so much.
Thank you, Teresa. So now we'll go over some of the updates to the Ohio Administrative Code due to the House Bill 33 that was passed. Historically, taxpayers who had elected to consolidate their commonly owned businesses have not been permitted to close their account in the middle of their 8-quarter renewal commitment. This administrative code 5703-2904 relaxes that requirement consistent with the CAT law changes that became effective January 1st, 2025. The CAT law changes also impacted our taxpayers who, as pre-income tax trusts, elected to file the Ohio Commercial Activity Tax. As these trusts often have less than 150,000 in taxable gross receipts, which clearly is less than the 3 million, they are now able to close their CAT account and are not required to file a zero tax liability return. This, however, does not revoke their election to file the Ohio CAT. More information about how the law impacted these pre-income tax trusts can be viewed with the Ohio Administrative Code 5703-2921. And both of these codes can be viewed on codes.ohio.gov. So now let's go over some frequently asked questions. So the first question we have here, what should I do now if I will not have more than 3 million in taxable gross receipts in 2024? Taxpayers who anticipate to have 3 million or less in taxable gross receipts in 24 should cancel their account effective 12/31/2023. The 2023 annual return was due May 10th, 2024, and the fourth quarter 23 return was due February 12th, 2024. The Gateway will allow you to backdate a cancellation request to 12/31/2023 if you wait until the final return has been filed to cancel the account. Again, there is a checkbox available with that final return. You'll simply check the box, and then we will cancel your account 12/31/2023. If you file using Telefile, you will not be able to cancel your account when you file your return. You will need to use the CAT cancel transaction through the Ohio Business Gateway, send the paper business account update form, which is located on tax.ohio.gov, or call the department directly and we can assist by phone. So our next question, who must file CAT? So this slide here is just a simple chart that goes over each year's threshold for 2005 through 2023. Taxable gross receipts of 150,000 or more, you are subject to the tax. Beginning 2024, if you have receipts greater than 3 million, you are subject to the tax. And then for 2025, and thereafter, if your receipts are greater than 6 million, you are subject to the tax. Our next question, do these changes impact periods prior to 2024? So here on this slide is the annual minimum tax information release. It explains the tiered structure and how the annual minimum tax is based on the prior year's taxable gross receipts. The annual minimum tax will still be applied to the periods prior to 2024. Our next question, if I am no longer subject to the CAT in 24, do I still have to file a CAT return for 23? The answer is yes. Taxpayers subject to the CAT must file for 2023. It does not take away from that filing requirement. 2023 annual returns were due on or before May 10th of 24, and the fourth quarter 23 return was due on or before February 12th, 2024. And our next question, as an annual filer, will I owe tax for 2023? There will not be an annual minimum tax payment due with this annual return. If you do exceed the 1 million threshold or the 1 million in taxable gross receipts, the only tax that is due is the 0.26% on the amount exceeding that $1 million. This next question here, what happens if I have taxable gross receipts that are slightly below the new exclusion amount and will likely increase in the next few years? So you do have some options. If you anticipate to exceed the 3 million threshold, you should continue filing quarterly returns. You will not have tax due until those receipts exceed that 3 million. On the other hand, you can cancel the account and then reactivate it once you exceed that new exclusion amount. Taxpayers are required to register and pay the tax within 30 days of exceeding that exclusion amount. So I have a new business that exceeded $150,000 in taxable gross receipts in May of 23. Will I still need to register for the CAT if I will not exceed that 3 million in 24? Taxpayers who have taxable gross receipts of $150,000 in the calendar year 2023 are subject to the CAT and will need to register, file, and then pay any tax that is due. You will owe the 2023 annual minimum tax, which is paid separately from the 2023 return. You will not have an annual minimum tax due for 2024 when you file the 2023 return. Once you file the return, you may cancel your account with an effective date of December 31st, 2023. And again, you can do this by checking the box at the end of the final return. So how do I cancel my CAT account? If you file a 2023 annual return or a fourth quarter 23 return on the gateway, you will see a checkbox has been added to the return to allow you to cancel the CAT account when filing. If you use this option, the CAT account will be canceled when you file the return effective 12/31/2023. You will not need to submit a separate cancellation request if you use this option to cancel your account. If, however, you have already filed your fourth quarter 23 return or the 2023 annual return and did not use the cancellation checkbox, you may still utilize the CAT cancel transaction on the gateway and are not required to amend the return. And again, annual filers who utilize Telefile will not be able to cancel the account when filing their return. You can cancel by submitting a business account update form, using the CAT cancel transaction on the gateway, or by calling the department. CAT accounts that are annual filers may be switched to quarterly beginning April 1st, 2024. This would make the due date for their first quarterly return in August, where they would report January through June 2024 activity. This allows taxpayers to file their 2023 annual return timely. There are also some annual taxpayers who receive refundable credit certificates from the Ohio Department of Development. And in order for these taxpayers to claim their credits on the Ohio CAT returns, they will be required to switch their accounts to quarterly and file those returns, even if their Ohio taxable gross receipts are less than $3 million. So this next question here, I am a combined or consolidated elected taxpayer. Does each member of the group account need to reach the new exclusion amount to remain subject to the CAT? The answer is no. The exclusion amount applies to the total taxable gross receipts for the group. Combined and consolidated elected taxpayer groups must consider the taxable gross receipts of all of its members of the group and determining whether the group will exceed the 3 million threshold in 24 and the 6 million in 25. So in other words, a combined group might have 10 members that all have receipts under 3 million, but once the receipts are combined, they exceed the 3 million. This combined group would then remain subject to the CAT as a group, they meet the filing requirement. This also includes taxpayers who file separately from the group. Be sure to include these separately filed receipts when determining if the group is still subject.
All right, so heading into our next poll question, it should be on its way to everybody's computer. The question is, what do I do if I exceed 3 million in 2024 but canceled my account? The three options are, the first one, leave my account closed, reactivate my CAT account within 30 days, start filing on the gateway. So give everybody a few more seconds to respond. If you're seeking continuing education credit, you don't have to get the question correct. We will give you the answer in just a few seconds, but you do have to interact with the poll. It's a good way to check your knowledge. If you are experiencing any connection issues, please send us an email at ovta@tax.ohio.gov so that we can make sure that we are taking a look at everything and give you the appropriate credit. So, Mary, what is the answer here? We have an overwhelming number of people who say reactivate my CAT account within 30 days. Is that the correct answer?
That is. It is very important that you reactivate your account when you exceed that 3 million to allow for successful filing.
Fantastic. Well, I will turn it back over to you now.
Thank you, Teresa. So here on this slide are some active links. On the left is a link to the new information release that details all the changes we went over today. And on the right-hand side is a link to our new webpage for CAT on tax.ohio.gov that has all the important changes, a link to the information release, and all the frequently asked questions that we reviewed. This page will be updated as additional information becomes available. If you have any questions after this presentation, please feel free to reach out to me directly or call the department for assistance. My email is mary.burkholder@tax.ohio.gov, and the CAT number to call is listed here on the screen at 888-722-8829. And also, if you have not yet signed up for tax alerts, please consider signing up for them. Any of the updates that are being made to the CAT will be sent out in a tax alert. And then lastly, please don't forget to follow us on social media. Important reminders and updates are shared on our social media pages. We do have a social media presence on LinkedIn, Facebook, X, previously known as Twitter, and YouTube. So this does conclude the commercial activity tax presentation. If your questions have not yet been answered, you will be receiving a response via email within the next few business days. I will now turn it over to Derek, who will discuss municipal net profit tax. Thank you.
All right, thank you, Mary. Good morning and welcome to the last section of today's Ohio Virtual Tax Academy. My name is Derek Schauer and I'm a tax examiner specialist in the excise and energy tax division, working with the municipal net profit tax. Today's presentation will cover the new updates that impact the municipal net profit tax for taxpayers opted in to file with the Ohio Department of Taxation. We're going to begin with House Bill 33, which was enacted by the 135th General Assembly in October of 2023. House Bill 33 contains many updates for municipal net profit tax. Due to this bill, the Ohio Department of Taxation has published an information release for these updates. It's titled MNP 2024-01 AMSUB HB 33 Updates, and this was issued in March of 2024. A link to this information release on our website has been inserted into this slide. The House Bill 33 updates I will discuss today are the new extended due date for net profit returns, a new apportionment election for remote workers, and a change in the late filing penalty, and a few minor updates for the municipalities. We will also discuss net operating loss deductions and how the end of the phase-in limitation for tax year 2023 changes the way NOLs can be utilized to reduce municipal taxable income. First up, the extended due date. The new extended due date allows for taxpayers that have requested an automatic extension to file their federal tax return to automatically receive an extension to file their municipal net profit tax return. For taxable years ending on or after January 1st, 2023, taxpayers that request a federal extension will receive 1 extra month to extend the filing of their net profit return. So for those taxpayers, the extended due date is now the 15th day of the 11th month after the last day of the taxpayer's taxable year. So for a calendar year filer, the extended due date now moves to November 15th. Previously, the extended due date would have been October 15th. Please remember that an extension of time to file the return does not extend the time allowed to pay any tax due. Please note that a taxpayer that has not requested or received a 6-month extension for filing their federal income tax return may request that the commissioner grant them a 6-month extension for filing the net profit return, as long as the request is received on or before the date the return is due. This means that without the federal extension, the return due date would go back to the 15th day of the 10th month. And this table that's on the slide here, there is a link to this table on our website provided. So the next few slides, we're going to demonstrate how to request a due date extension from the Ohio Department of Taxation using the Ohio Business Gateway. I do want to point out that the correct service area for taxpayers opted in to file net profit taxes with the Ohio Department of Taxation is titled ODT Centralized Filing - Municipal Net Profit Tax, as seen here on the slide. There is a second service area that has municipal net profit tax in the title. This service area, though, is for taxpayers not opted in with the Ohio Department of Taxation, but rather for those taxpayers who file their returns directly with the municipalities, with RETA or CCA. If you need assistance with locating or adding the correct service area, please reach out to us using the contact info at the end of this presentation. So back to the request. So to make the request for the extension, first navigate to gateway.ohio.gov and log into your Ohio Business Gateway account. From the My Business dashboard, locate the ODT Centralized Filing Municipal Net Profit Tax Service area and click on the transaction for the annual tax filing due date extension. After selecting that transaction, you'll receive this page here. Please select the due date extension. Here on this slide is your company information. The federal employer ID is auto-populated for you, but you will need to enter in your ODT net profit account number and the taxable year begin and end dates. This next page here is the review prior to submission. Here, you just want to verify that the information that you have entered is correct. You want to check the perjury statement box and then click to submit. After submitting, you will receive this confirmation page. This is an acknowledgement that the tax due date extension has been received by the Ohio Department of Taxation. One other side note about the extension. We get a lot of inquiries about how to make an extension payment with the extension request. In order to make an extension payment through the Ohio Business Gateway, you need to do a separate transaction. So after submitting the extension request, return to the My Business dashboard and select the payment only transaction. Here you can submit a lump sum payment for the amount that is needed. This payment cannot be allocated to any specific municipalities. It gets allocated based on the last declaration filed with the Ohio Department of Taxation.
All right, so a poll is distributing right now. So the question is, what is the extended due date if a taxpayer requests a federal extension? Is it the 30th day of the 6th month, the 15th day of the 11th month, 15th day of the 10th month, or none of the above? So we'll give everybody a couple of seconds to respond. Again, if you are seeking continuing education credits, we do need you to click on a response and submit that. You do not need to get the question correct. We'll give you the answer in just a moment, but we do need you to interact with the poll. And if you're having any connection issues, please send us an email to ovta@tax.ohio.gov. I know I've sent a couple of chat messages already with that. I will be sending another one towards the end of today's webinar so that everybody has that email address, but please send us an email if you are having any issues. So Derek, what is the correct response here?
The correct response for this question would be B, the 15th day of the 11th month. That's for a federal extension. Like again, without the federal extension, it is the 15th day of the 10th month. So the answer to this one though is B, 15th day of the 11th month.
Fantastic, thank you so much, and I'll turn it back over to you.
Thank you. The next topic up for discussion today is the new apportionment for remote workers. This information can be found on the Ohio Revised Code section 718.821, and there's also additional information in 718.021. In this section, we will discuss how to revoke the election, what makes up the modified apportionment formula, and the factors used. This section does cover an in-depth look at how the new apportionment for remote workers can be used. There are a lot of terms that I will define, and at the end, there will be an example where we'll tie it all together. So making the election. If a taxpayer wishes to make the election, they must notify the tax commissioner in writing. This can be either when filing an original net profit return, when filing a timely amended return that they now want to take the modified apportionment election on, or they can make the election on a timely filed appeal of an assessment. This election applies to the taxable year in which the election is made and for all subsequent tax years until the taxpayer revokes this election. Once the election is made, it applies to all municipalities in which the taxpayer conducts business. To make the election in the Ohio Business Gateway, as shown here on the slide, simply check the box here on line 2 of the Schedule B header, titled Election to Apportion to a Qualifying Reporting Location for Remote Workers. Please make a note that on each subsequent tax year when filing through the Ohio Business Gateway that you will need to check this box on every year's original return. If the taxpayer then wishes to revoke this election, uncheck this same box when filing an amended return to go back to the default apportionment rules. And if the taxpayer does decide to revoke this election to use the new method, they can decide to make a new election at any time. There's no waiting period that applies when you want to make the election. Okay, so if a taxpayer elects to use the new apportionment for remote workers, they will use the modified apportionment formula. This formula is made up using the same 3 factors as before, but the situs of these factors will be different. Also note that there's a lot of bolded terms. I will try to define these terms on the next few slides. So the 3 factors that make up the formula are the property factor. This is the average original cost of any tangible personal property used by a qualifying remote employee at that individual's qualifying remote work location. This property will be situs to that individual's qualifying reporting location. The second factor is the payroll factor. That's any wages, salaries, and/or compensation paid during the taxable period to a qualifying remote employee for services performed at that individual's qualifying remote work location. These wages will be situs to that individual's qualifying reporting location. And last is the receipts factor. This is any gross receipts of the business from services performed during the taxable period by a qualifying remote employee at that individual's qualifying remote work location. These receipts will be situs to that individual's qualifying reporting location. Okay, so that's the formula. Now let's define some of these bolded terms. The first one up is, what is a reporting location? This is either a permanent or temporary place of doing business that is owned or controlled directly or indirectly by the taxpayer, or any location in this state owned or controlled by a customer or client of the taxpayer, provided that the taxpayer is required to withhold municipal income taxes on any qualifying wages paid to an employee that performs personal services at that location. Next, let's define what a qualifying reporting location is. This is one of the following. It's either A, the reporting location in this state where an employee performs services for the taxpayer on a regular or periodic basis during the taxable year. Or B, if no reporting location exists under A, then the reporting location is where the employee's supervisor regularly or periodically reports during the taxable year. And finally, C, if no reporting location exists under A or B, then the reporting location becomes where the taxpayer otherwise assigns as the employee's qualifying reporting location, provided that the assignment is made in good faith and maintained in the taxpayer's business records. And also, a taxpayer may change the qualifying reporting location designated for an employee at any time. And finally, what is a qualifying remote work location? This is a temporary or permanent location where an employer or owner chooses or is required to perform services for the taxpayer, other than a reporting location of the taxpayer. This may include the residence of an employee and may be located outside of a municipality that imposes an income tax. And an employee or owner may have more than one qualifying remote location during a taxable year. Okay, so now we've defined what the different types of locations are. Now let's define what is a qualifying remote employee. This is an individual who is an employee of a taxpayer or a partner or member holding an ownership interest in a taxpayer that is treated as a partnership for federal income tax purposes, provided that the individual meets both of the following criteria. The taxpayer has assigned the individual to a qualifying reporting location, and the individual is permitted or required to perform services for the taxpayer at a qualifying remote work location. Okay, so I know that was a lot of information, and we have a little bit of understanding of what the new modified apportionment formula is. Let's try to put it all together here with this remote worker example. So the taxpayer's headquarters is located in Columbus, which is the only location that the taxpayer owns. All the taxpayer's employees have the option to work from home 4 days a week, but must report to the headquarters at least once a week. The taxpayer's employees live in various cities, villages, and townships around the state. But instead of apportioning property used and sales and services provided at the location of the employees' homes to those various locations, the taxpayer makes the election to use the modified apportionment method for its employees that work remotely. So the reporting location for the taxpayer is Columbus, because the headquarters location is a permanent place of doing business that is owned or controlled by the taxpayer. The qualifying reporting location of the taxpayer is also Columbus. The employees is also Columbus, because they are required to report regularly to the headquarters location in Columbus during the year. As stated earlier, they have to report at least once a week. So upon making this election, the taxpayer must apportion the property, payroll, and receipts attributable to its qualifying remote employees as follows. The average original cost of any tangible personal property used by the taxpayer's employees at their home locations must be cited to Columbus, and any wages, salaries, and other compensation paid during the taxable period to the taxpayer's employees for services performed at the employees' homes must also be cited to Columbus. And any gross receipts of the business from services performed during the taxable period by the taxpayer's employees at the employees' homes shall be cited to Columbus. I know that's a lot of information, so please again see that information release on our website or the Ohio Revised Code, again, section 718.021 and 718.821.
All right, so heading into our next poll question, which should be on its way. The question is, does a taxpayer need to notify the tax commissioner when making the election to use the modified apportionment method? Yes or no? So we'll give everybody a few seconds to respond to this. Again, if you're seeking continuing education credits, we just need you to select an option. We will be giving you the correct answer in just a moment. So if you're unsure, please just select one of the two options, and we will clarify in just a moment. If you are having any connection issues and you're not able to vote in the poll, I did just resend a chat message with our email address, and that email address is ovta@tax.ohio.gov. Again, that is ovta@tax.ohio.gov. So Derek, what's the correct answer here?
Thanks, Teresa. Yeah, so the answer for this second question here is yes. They must notify the tax commissioner when they make this election. And that could be done either on the original return, on a timely filed amended return, or an appeal of an assessment.
Fantastic. Thank you so much, and I'll turn it back over to you.
Thank you. Okay, so now we're going to turn our attention to a few of the minor updates that were in House Bill 33. First up is the late filing penalty change. This is the revised code section 718.89, and beginning with taxable years on or after January 1st, 2023. If a taxpayer fails to file their net profit return timely, they will be subject to a late filing penalty. This late filing penalty is now a flat fee of $25. Prior to taxable year 23, this penalty was $25 per month, up to a maximum 6 months or $150. Also included in this update is that the first time the taxpayer files late, the tax commissioner will automatically abate this penalty. There's no action needed to be taken by the taxpayer. The second time the taxpayer files late, the taxpayer may request an abatement of the late filing penalty, either over the phone or in writing, but not until the tax and interest have been paid. The second minor update is for tax notices. You can see revised code section 718.85 for this information. It just simply states that if a taxpayer receives an extension for filing its federal return or requests an extension for filing its municipal net profit tax return, the tax commissioner will not send any notices or make any inquiries about that return to the taxpayer until the date of the taxpayer files the return or the extended due date of the return, whichever of those occurs first. And we did have 2 updates pertaining to the municipalities. The first one being rate certifications. On or before January 31st every year, each municipality imposing an income tax must certify their rate. With this new update beginning with taxable years on or after January 1st, 2023, the municipalities are now required to certify any tax rate changes to the tax commissioner not less than 60 days before the effective date of the new rate, after which the new rate will take effect. And the second municipality update is about the semi-annual return reports. This is a change in how the reports will be sent to the municipalities, beginning with taxable years on or after January 1st, 2023. For any taxpayer that conducts business within a municipal corporation, the Ohio Department of Taxation will provide a semi-annual return report showing municipal taxable income apportionable to that municipality during the semi-annual reporting period. Due to the new extended due date, the reports will now be sent each May and December. Previously, these were sent out in May and November. And for information on that, you can see revised code section 718.84. Okay, so that concludes this portion of House Bill 33 updates. We're now going to move on to the net operating and loss updates. So the Ohio Department of Taxation has published an information release titled MNP 2024-02, Update on Net Operating Loss Deductions. This was issued in April of 2024. Again, there is a link to this information release, and that can be found at the beginning of this presentation on slide 3. The purpose of this information release is to provide an update on the net operating loss deductions available for the municipal net profit tax for taxable years 2023 and after. This update was created due to the passage of House Bill 5 in December of 2014. When House Bill 5 was enacted, it authorized taxpayers to claim NOL deductions with a standardized carry-forward period of 5 years in every municipality that levies an income tax. The NOL deduction was phased in over a 5-year period from taxable years 2018 through 2022 and was subject to a 50% limitation during the phase-in period. Additionally, the 50% phase-in limitation did not apply to any municipal corporation that levied a new tax beginning on or after January 1st, 2016. In these municipalities, the taxpayer could use 100% of the available NOL to reduce income to zero. While the 50% limitation was in effect, the NOL deduction was limited to the lesser of either 50% of the adjusted federal taxable income or 50% of the available NOL. But for effective for tax year 2023 and after, taxpayers may now use 100% of the remaining balance of unexpired NOL deductions available to them, up to the amount necessary to reduce that taxpayer's municipal taxable income to zero. With the exception of NOLs that were incurred prior to taxable year 2017, All NOL deductions reduce municipal taxable income on a pre-apportionment basis and have a standard 5-year carry-forward period. After the 5-year carry-forward period, any unused NOL deductions expire and may not be used to offset future income. For example, in taxable year 2023, any NOL that was incurred in taxable years 2017 has expired and may not be used. The entire remaining balance of a taxpayer's NOLs in 2018 through 2022 that are unused and unexpired may be deducted to offset a taxpayer's municipal taxable income in 2023. Likewise, for taxable years 2024, the unused and unexpired NOLs from taxable years 2019 through 2023 may be deducted, and any unused NOL from taxable year 2018 has expired. Also, prior to the passage of House Bill 5, some municipalities allowed NOL deductions to be carried forward for longer than 5 years. The Village of Jewett allows a pre-2017 NOL to be carried forward for 7 years. This deduction is allowed through the 2023 tax year. And also the Village of McDonald allows a pre-2017 NOL to be carried forward for 10 years. This deduction is allowed through the 2026 tax year. Taxpayers in those municipalities may still have pre-2017 NOLs eligible to be carried forward and used to offset municipal taxable income. These NOLs are applied on a post-apportionment basis and may be used in conjunction with any unused and unexpired 2016 NOLs.
All right, so time for our final poll of the day. I know that probably makes everybody on here so sad to have our final poll, but it should be on its way to everybody. The question is, what is the last year an NOL incurred in 2017 can be utilized? Is that 2020, 2023, 2022, or none of the above? So again, if you're seeking continuing education credits, you do need to interact with this poll. So please select a response. It does not need to be the correct response, but we do need you to interact with the poll. If you are having any sort of connection issues and you cannot click on one of the responses, please send us an email to ovta@tax.ohio.gov. Again, that is ovta@tax.ohio.gov. So, Derek, as we're getting the last couple of responses in, what is the correct answer here?
Yeah, the correct answer is C, 2022. The NOL is limited to a 5-year carry forward period. So any NOL that was incurred in 2017 is allowed to be utilized on returns between 2018 and 2022. So the answer would be C, 2022.
Fantastic. Thank you so much. And I'll turn it back over to you.
Thank you. Okay, so now we're just going to walk through how a taxpayer with post-2016 NOL deductions can use them to offset income, and how the end of the phase-in changes how they can be utilized. So this taxpayer in this example has income for 2021 after incurring losses in prior tax years. This taxpayer has total losses between 2017 and 2020 in the amount of $220,000. For 2021, the phase-in limitation is still in effect, so the taxpayer can only utilize the lesser of either 50% of the adjusted federal taxable income or 50% of the NOL available. So for tax year 2021, the income is $130,000. 50% of that income is $65,000. The NOL available is $220,000, and 50% of the available NOL is $110,000. Again, the 50% limitation is in effect. So 50% of the income in this example is lesser of the two figures. So the taxpayer is limited to only utilizing the $65,000 of the available NOL deduction. The taxpayer can use all of the deduction, all of the NOL from 2017 and $35,000 from 2018. The remainder of the 2018 and all the 2019 and all the 2020 NOLs go forward to the next tax year. Again, on the 2022 return, the taxpayer again has income, this time of $220,000, which 50% of that income is $110,000. The total NOL available is $155,000, and 50% of that is $77,500. Again, the phase-in is still in effect. So since the 50% of the income, or excuse me, of the NOL is the lesser of the two figures, the taxpayer is limited to utilizing the $77,500 available in NOL deductions. The taxpayer may use the remaining $45,000 from 2018 and $32,500 from 2019. Again, all the remaining NOLs get carried forward to the next taxable year. However, starting with the 2023 return and all returns after, the phase-in limitation is no longer in effect, and the taxpayer can now utilize 100% of the available NOL up to the amount of income. So if in taxable year 2023, the taxpayer has income equal to or more than the remaining $77,500 in available NOLs, that taxpayer would be able to utilize that full amount. In this next example, we see that the taxpayer had a large loss in 2017, which is being used to offset multiple years of income, and will have a remaining NOL that will expire. This is to show that any remaining NOL unused or unutilized that reaches the end of the 5-year carry forward period expires and cannot be used to offset future income. The phase-in limitations are still in effect. For this example, the income is always the lesser of the two figures. For 2021, the taxpayer's income is $130,000 and can be offset with $65,000 of the 2017 NOL. In 2022, the income is again lesser. It's $185,000. Again, 50% of this is used. 50% of the income is the limit that they can use on the NOL. Again, they used $92,500 in 2022. That leaves a remaining balance of $142,500 that is unused and unexpired, as you see on the slide here. But for 2023, if the taxpayer files and has income, they are allowed to utilize the full $190,000 of NOLs that are remaining and unexpired. All right, so that's going to conclude today's presentation on the municipal net profit tax updates. I want to thank you for your time and your participation. Again, if you have any questions on the information shown today, please feel free to reach out to our team at mnptax@tax.ohio.gov or call the department at 844-238-0403. Again, if you haven't signed up for the tax alerts, please consider signing up for them and check us out on any one of our social media platforms. Thank you.
All right, thanks, Derek. I'm gonna thank everybody for being with us today. We had a lot of really great presentations today. Hopefully you got some good information. Also would like to announce that we will be onboarding a handful of our business taxes to our OH Tax e-services in December of this year, and that's going to include our sales tax and our employer withholding taxes. Information will be posted on tax.ohio.gov/info/OH-tax as we progress towards go live, and I'm going to send that link in a chat to everybody, so that should be on its way to you. Just to wrap up some of our housekeeping items, anybody who's seeking continuing education credits, we should have those all finalized by May 31st. We will be emailing Ohio CPAs your certificates directly to the email you used during registration, and for Ohio attorneys, we'll upload the credits to the Supreme Court's website. If you had any connection issues, please send us an email to that email address I keep saying, OVTA@tax.ohio.gov, and we can make sure that we are getting your credits as good as we can. We will be sending a survey link to everybody. We'd love to get your feedback on what you thought of the program. We'll also be posting the recordings no later than May 31st. on our website as well. And then we are having another session of the Ohio Virtual Tax Academy tomorrow. That's going to be geared towards some small businesses. We would love for you to join. If you are here for continuing education credits, we will not be offering continuing education credits tomorrow, but we would still love it if you would join us. So at this point, I am going to conclude the OVTA, and thank you so much for spending your morning with us.